Welcome to Stock Market Palantir. In this video, we'll be breaking down another stock analysis. Be sure to subscribe and drop your opinion in the comments. Okay, let's hear from our analysts.
Welcome to another NVO analysis. This time, we will analyze the company stock from different perspectives. We're looking at Novo Nordisk AS, which is currently trading around $52.56. And it presents, I think, one of the most intellectually challenging investment narratives we've seen in a while. This is a stock that just suffered a severe, really debilitating 40% drawdown in 2025, and it's completely decoupled its performance from the broader market indices, most notably the surging NASDAQ 100. So the essential question for us, as we're analyzing the technical market dynamics, is whether this technical collapse, this deep trough in the price, justifies the market's extreme pessimism. Or, and this is my view, if the technical signals actually point toward a massive contrarian opportunity, suggesting the selling is just utterly exhausted. I'm going to argue that the indicators, specifically the unusually low short interest and the critical shift in who owns the stock, suggest that NVO is washed out and is actually set for a pretty dramatic re-rating.
And, well, I come at this from a slightly different perspective. I certainly acknowledge the stock has been, brutally punished. But the technical activity we've seen, especially that dramatic, almost violent downside capture and the complete decoupling from the rest of the growth sector, that to me confirms the severity of the structural growth concerns that the market is currently pricing in. And crucially, that high free float, well, it adds a whole other layer of technical risk, allowing for swift institutional capitulation if the company continues to falter. Which is, that's what got us into this mess in the first place.
I hold that the current technical sentiment is not just high fear. It's indicative of what you might call peak fear, total institutional capitulation. And that creates a really asymmetric risk-reward profile that is heavily skewed to the upside for patient capital. Let's just look at the hard data for a second. The total short interest, it stands at approximately 29.6 million shares. Now, that sounds like a lot, but it only represents about 0.9 to 1.2% of the total float. That absolute low level is the key. It confirms this decline was absolutely not driven by some massive concerted short-selling attack. If it were, those numbers would be way, way higher. So this tells us the downside pressure was driven by existing long holders, the momentum funds just liquidating, and that long holder capitulation, well, it's a textbook bottoming signal. We've actually observed this institutional rotation in real time. Fast money funds like Kestra have been selling off in huge volume, and they're being systematically replaced by deep value funds, specifically Greenkeeper Asset Management, which has been building significant multi-year positions down in the mid-40s. This is patient capital looking for compound returns, and that signals a fundamental shift in the ownership profile.
Okay, that is a compelling analysis of the selling mechanics, I'll grant you that. But I have to argue that the market correctly penalized NVO. The technical activity just confirms that the drawdown was justified by a confluence of issues, execution errors, those persistent supply constraints, and then the guidance cuts that followed.
And those risks, they haven't just vanished. So while I agree the absolute short interest level is low, we have to focus on the trend. In the latter half of 2025, short interest actually rose by about 9.4%. That uptick, even if the absolute number is small, it signals that some sophisticated, money-smart money is actively building downside positions. They're either betting on more fundamental deterioration or, maybe more likely, using NVO as a precise hedge against their long positions in the competition, namely Eli Lilly.
Right. The stack's inability to rally, showing that extreme downside capture, even when the NASDAQ 100 was on a tear. That confirms NVO is dealing with structural, company-specific headwinds, not just some general market malaise. And to explore that 9.4% rise in short positioning a little further, we need to ask why this stock is being shorted now, after such a huge decline. The skeptics, seeing that rise, they feel justified betting against this idea that NVO is just a cheap duopolist. They're focused on the stark reality of stalled earnings per share growth, which is forecasted at only 5% for 2026. And what's more, they are capitalizing on the massive, and I would argue unsustainable, valuation gap that's opened up between NVO and LLY. NVO trades at a meager 14 times forward PE, while Lilly is trading north of 50 times. Short sellers are essentially betting that until NVO executes perfectly on its launches, that valuation gap must persist. That 5% growth just isn't enough to justify a multiple anywhere near Lilly's.
I see why you anchor on the valuation gap, but I think you're missing the context that explains why the gap exists, which, brings us right back to the technical data. The reason NVO is at 14 times and LLY is at 50 isn't just growth, it's perceived risk. Risk that has, frankly, already played out. My core counterpoint to the short interest argument really centers on the days to cover ratio. That's perhaps the most crucial technical metric here.
Okay, could you maybe elaborate on that metric for our listeners?
Absolutely. So for those less familiar with the technical details, the days to cover ratio just tells us how many days it would take for short sellers to exit their positions to cover, based on the average daily trading volume. And in NVO's case, that ratio is extremely low. It's ranging from 1.2 to 3.4 days. This low figure is so critical because it confirms the selling pressure throughout that 40% crash was not driven by massive short positions trying to force a collapse, a short squeeze. If there were some big structural short imbalance hanging over the stock, that ratio would be in the double digits, signaling trapped bears who would eventually have to buy back and generate a rally. Instead, the low ratio confirms the selling was simply institutional longs getting out. The capitulation of the growth momentum crowd, they are gone. And the stock is washed out precisely because those impatient holders have finally cleared out.
That is a robust counterpoint, but I find myself still anchored on the fact that a low days to cover it's a double-edged sword when you pair it with the fundamental risk. Yes, it means a squeeze isn't likely, but it also means that if the company releases bad news, say a delay in the oral Wegovy launch, short sellers can get out of their positions rapidly, efficiently, without creating any buying support on the way out. It doesn't signal safety to me. It signals structural efficiency in bearish positioning.
Well, that efficiency of movement actually pivots perfectly into our analysis of the free float. The exceptionally high free float, 94.06% of the B shares, which trade as ADRs, provides the necessary liquidity for what I call the accumulation thesis.
I think you're framing this high liquidity too narrowly. It means that large, value-oriented institutions like Greenkeeper can aggressively build massive, multi-billion-dollar positions in that $45 to $52 range without, destabilizing the price or creating undue slippage. This high liquidity is actually facilitating the shift of NVO ownership from that volatile momentum crowd to patient, long-term capital. I'm just not convinced by that line of reasoning because, as I said before, that high liquidity is what enabled the violent sell-off in the first place. You are framing a structural feature as if it's some new advantage. The high free float is exactly what allowed for the institutional liquidation and the violent 40% downside we saw throughout 2025. It allowed funds to rapidly and efficiently capitulate. The structural risk is still there. This highly liquid structure means that if the complex launch of the oral Wegovy cash pay model hits a major snag, or if the emicrotine phase 3 data disappoints in early 2026, that same liquidity enables another swift, catastrophic exit, maybe even faster this time. Liquidity, well, it only cushions you when sentiment is positive. In times of genuine fear, it just facilitates a faster liquidation. And that brings us to the technical signal from the stock's absolute decoupling from the market. We saw an inverted correlation with the NASDAQ for most of 2025, and NVO's beta, which is, a measure of its volatility relative to the market, fell dramatically to 0.67. This low beta signals that the market is treating NVO not as a typical high-growth pharma company, but more like a utility stock facing these profound political and competitive risks.
A beta that low, minus 0.67, is remarkable. I agree with your definition of what it means. It means NVO barely moves when the rest of the tech and growth market surges. It's pricing risk entirely on its own terms, totally decoupled from the macro story. So yes, the market views it like a fixed income play or a utility.
Exactly. And this technical behavior reflects a permanent, I think, structural change in sentiment. It's been validated by things like the failed Alzheimer's trials and the superior efficacy of competitors like Zepbound. The market is pricing in structural constraints that limit its potential for multiple expansion to that 14 times PE range, almost regardless of the pipeline.
But I would argue this extreme divergence and downside capture is precisely the technical manifestation of a cyclical low, a pricing trough. It is not permanent. It's the price you pay for total pessimism. The stock is already pricing in every single piece of negative news you just mentioned. I mean, when the consensus analyst price target falls to $53, which is essentially in line with the current price, well, it suggests that expectations have been fully, brutally, and comprehensively reset. The market has literally priced in failure. This exhaustion of pessimism is what sets the stage for a dramatic technical rebound, driven not by the general market, but specifically by the catalysts we know are coming.
So you mean the pipeline?
Yes, exactly. We are looking at the December 2025 FDA approval for oral Wegovy, which everyone expects, by the way, and the impending amycretin Phase 3 initiation scheduled for Q1 2026. The technical setup, with the low days to cover and the long liquidation, it all suggests the market has nothing left to sell. Any positive news will be met with a dramatic surge as that patient capital I mentioned tries to re-rate the stock closer to its real value.
Okay, while I acknowledge the technical picture is extremely washed out, which is why the stock is just sitting here at $52, I still maintain that the high free float combined with that continued hedging activity from the rising short interest means the stock remains highly sensitive to execution failures. The new CEO, Dostradar, has virtually no margin for error, particularly with that complex and totally novel $149 cash pay model for oral Wegovy. If that model hits any snags, this highly liquid stock will be punished immediately, and those shorts will be vindicated. We are really betting on operational perfection versus technical exhaustion.
From momentum to deep value, it all strongly suggests the stock is bottoming. Ownership is transitioning into patient hands. Investors are now acquiring a robust duopolist in a market projected to hit a $150 billion TAM at a utility like 14 times forward PE. That represents a profound 72% discount to its main competitor. And crucially, the current 3.3% dividend yield provides a real yield floor and a downside cushion. The downside risk is limited and defined, while the upside remains entirely uncapped by what is essentially a free call option on the potentially revolutionary amycretin pipeline.
Well, at the end of the day, analyzing these technical movements, the institutional flow, the short sentiment, the liquidity, it's crucial because it gives us a window into the market's psychological valuation, which is, for now, just stubbornly disconnected from the fundamental reality.
The market feels like this stock is only worth $52. That reflects a deep structural fear.
And the core debate is whether that psychological disconnect can possibly persist when the underlying intrinsic value estimates, based on their pipeline and market position, often place the fair price closer to $74 a share. Understanding the full picture of NVO requires weighing that deep market fear, which we see in the technicals, against the fundamental opportunity that is reinforced by that massive TAM and the pipeline potential.
If you enjoyed this video and want to watch more analysis like this, don't forget to subscribe to the Stock Market Palantir channel. Thanks for watching, and see you in the next video.